I'm Lisa Abramowicz. Welcome to Bloomberg Money Undercover, a show that provides valuable insights into alternative investments. We take you inside the world of private debt, equity, and real estate. Let's get straight into the burning issues in private markets. Banking on illiquidity, credit buyers making increasingly concentrated bets in risky companies. Next, cross-border trade. We're looking at the state of Asian investment in U.S. real estate. Plus, we speak with the Chief Executive Officer of Barings on expanding in Asia despite ongoing trade uncertainty. Well, let's get straight into some of these burning issues. With me, I am pleased to say, Bloomberg's Kelsey Butler, Brian Chapata, and Craig Giammona. Let's start with Kelsey. Private equity firms increasingly taking business from the broader syndicated loan market. The latest example of this can be found in a once obscure type of loan that's becoming more common. Kelsey, can you just give us a sense, what is this loan?
Yeah, so unitranche financings, sometimes they're called one-stops, are a type of debt structure that combines first priority and subordinated debt into one. And what we've really seen this year is that volumes for this type of financing have really boomed. It used to be pretty rare to see one that was larger than $1 billion. And in the last few months, we've seen several, including a $1.8 billion one for the New Media and Gannett merger.
Okay, so these are concentrated bets made by private equity firms. Sometimes they get together and that don't necessarily delineate first lien, second lien. So what is the risk here?
So the risk for direct lenders or the private equity firms that are making these loans is twofold. For one, the pricing on unitranches has really compressed, so they're not necessarily being compensated for the additional risk that they're taking on. Second, sometimes these unitranches are chopped up and sold further, and those types of side deals haven't really been tested in restructurings or bankruptcies.
Wow, this is really interesting and brings us to Brian and our next topic, which is growing risk. There's been an increasing amount of distress seen in specific slices of riskier credit markets, and there is a question, how much should we care? I'm talking particularly about CCC rated credit.
Yeah, I mean, I hate to say it, but you don't want to paint it with a broad brush, to use the cliche. The feeling is that there's only 285 names in the CCC index, or bonds rather, not even names. And then there's 2,000 bonds in the broad junk bond index as a whole. So you look at names like Frontier Communications, McDermott, California Resources. These are bonds that have been really hammered, and that's really blowing out spreads. Compared to double Bs, single Bs are still very tight.
Right, and we've seen that the extra yield that investors are demanding to own CCC credit over benchmark rates has risen to the highest level since 2016. A lot of people saying this has to do specifically with energy, but it's not just that. You're seeing loan covenants starting to tighten up as people get a little concerned. You're seeing downgrades outpacing upgrades among junk-rated companies by S&P by the most since 2009. When do we start to care about all this?
Well, I think leveraged loans are the really interesting place to look at because it goes beyond just, is there a credit problem here? It's the fact that the investor protections are weakened. So you might see distress start to creep in even earlier than expected because people are starting to worry about, will they be protected in the event of some sort of distress or default situation, and they'll want to get ahead of that.
But right now, people are viewing this mostly as idiosyncratic-driven spread widening.
Yeah, I think so. I mean, the double Bs are below 200 basis points now, and that's tight relative to any time in the past 15, 20 years.
Which brings us to Craig, and some people are blaming the trade war for all of the tepid risk demand across the board on the margins. They certainly blame the trade war for some of the weakness we're seeing in the U.S. luxury real estate market, particularly in Los Angeles. Can you talk a little bit about that?
Yeah, there's been a really big drop in basically luxury condo sales in the third quarter. And what people are telling us is that condo sales are down 30%, and that really over the last couple of years, 50% of those purchases, roughly speaking, were from Chinese buyers. So that's really showing up in the numbers that the Chinese are having a harder time getting the money out of the country, especially for real estate deals, and that's really hurting the market in downtown Los Angeles.
How pervasive has the pullback in Chinese money been? I mean, has it just been in LA real estate, or has it been across the board in luxury properties throughout the U.S.?
You know, it's been across the board. I think it shows up in markets where Chinese buyers are a bigger percentage of that pool. So in a place like New York, there's a lot of factors to why we have a problem in our luxury real estate market. In Los Angeles, Angeles, especially in downtown Los Angeles, condos are kind of new, and Chinese buyers were a big chunk of those buyers. So you're really seeing it show in those numbers.
Craig Gimona, thank you so much. And to all of our reporters, we appreciate it. It brings us to my next guest, Al Rabel. He's Chief Executive Officer of Kayne Anderson Real Estate. And I want to first just talk about that pullback that we've seen in international investing. Has it just been from Chinese investors, or has it been across the board with foreigners pulling back some of their property investments in the United States?
We've seen it primarily with Chinese. We see continued interest from Australia, Asia, generally speaking, ex-China, Europe, even Latin America, really.
Which markets has it affected the most, the Chinese pullback?
The gateway cities, New York, Miami, LA, San Fran.
All right, so let's talk about where you are seeing opportunity. We know that there's been a lot of interest, particularly in senior housing, and you've been among those interested. Can you tell us a little bit about where the opportunity is there?
Sure. On the senior housing side, you've got a demographically driven sector where you're going to see huge demand increases over the next 20 years. So we're going from essentially 40 million Americans 65 and older to 80 in 2030. That's from 2010 to 2030. So obviously a huge demand increase on the housing side. We play the higher end of that sector. So we're in private pay, major markets, sort of top 75 MSAs. And we think we're in the very early stages of, a very significant sector cycle.
All right, a lot of people have been talking about this for a while. Everyone's getting older, getting sicker, needs somebody to take care of them and change the diapers. But the thing is, we haven't actually seen that happen as much. And people are actually staying healthier, and to the degree they can, they're staying in their home with new advancements. And we're not seeing the turnover in housing. What's going to sort of tip the scales here?
I'd say to some extent that's true, to some extent it's not. What we're really looking at is a lifestyle. So what we own are places where people go to live, not to die. So the social connectivity, the lifestyle, we've got a saying, a mantra, if you will, cruise ship living on land, which kind of depicts what we're shooting for. And that's where, places where people wake up in the morning and they say, I want to do yoga at 8, I want to do Pilates at 9, I'm going to eat at 11, I've got a spa service at 1, I've got happy hour at 3:30, and then they wake up the next day and decide what they're going to do then too.
So Boca.
Boca.
Is it Boynton Beach? I mean, is that where you're in? Like, where are
We've
these
got
places?
heavy concentrations in the southeast and southwest, so we obviously gravitate towards the demographic inflow states, but we've got a great property here in New York, and we look for major markets where you've got enduring demand dynamics and supply constraints.
All right, so senior housing, hot. Another hot area, warehouses. We've seen a lot of investors, including Blackstone, invest heavily in the warehouse industry. Are there still opportunities, or are prices now so high that it's a good time to sell?
That's probably a better question for Blackstone than for me. We've got a very specific investment focus with what we do. So we do senior housing, medical office, student housing, all demographically driven, all operationally intensive, all highly fragmented sectors. So, it would just be pure speculation on my part, but the thesis for us is to be not correlated to the macro economy or to the real estate cycle. So what we're looking to do is have very steady cash flows driven by those enduring demand dynamics and supply constraints. So warehouse, I would say, has been largely driven by increasing demand, but we have yet really, since industrial's gotten hot, to see a pullback. And at some point, we're going to have a recession here in the U.S., if not a global recession. And that certainly may impact the positive trend that we're seeing on the warehouse
Which is
side.
exactly where I wanted to go, actually, because we've seen a number of figures out of the U.S. that have actually been positive, shown increasing strength in the U.S. property market. Do you think that that means that we have another couple of years before that downturn in the real estate market?
On the opinion side, I would say yes. I think we're in a Goldilocks economy for real estate. I don't see a catalyst in the near term that's going to have interest rates spike higher. So asset valuations as a result are going to stay high, and I think it's a very good environment for real estate generally. So I think even if you're looking at the more what I'll call commoditized asset classes like multifamily housing, we see enduring demand dynamics for at least the next few years.
All right. My takeaway here is cruise ship on land.
Cruise ship
thank you so much, Al Rabel. He is Kayne Anderson Real Estate Chief Executive Officer. Coming up, this week's Power Player, Tom Fink, Chief Executive Officer of the $335 billion global financial services firm Barings. He tells us what his company is faring well, and particularly how it's doing in China since the company opened its markets a little bit ago.
We were benefiting from that over the last 2 years. Now, broadly, China needs to open their markets even more. And the trade war makes that harder because of this tit-for-tat mentality between the U.S. and China.
I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now time for Power Play, our look at some of the most notable names in private markets. More and more global financial firms are planning to expand in Asia, particularly in China, which comes even amid the U.S.-China trade war, as well as concerns about slowing growth. I spoke with Tom Fink, Chairman and Chief Executive Officer of Barings, about the opportunities and the potential risks of operating in the region.
Direct lending into China is really nascent at this point. So that's not where we're focusing as much as the other parts of the region.
Okay. So in terms of the legal structure, how much does that matter to you, given the fact that that's kind of key to recoveries?
Well, that's why you see a lot of the direct lending in Asia are in systems like Australia, where they have more westernized forms of bankruptcy. China's still evolving. Now, there's a lot of firms that say we can go in there and play in the MPL game and things like that, which is fine, but you're dealing with a, if you will, a bankruptcy legal system that's less proven.
How important is a trade deal to determine what you do in Asia?
Trade deals will impact the economy. They will impact, if you will, how we do business. In some ways, I think this trade war has made it somewhat easier to get on the mainland for firms like ourselves.
How so?
Well, you know, a lot of the process we went through in the last couple of years to be licensed, frankly, went better than we thought. So maybe there's a little bit of China needs to open its markets, and where are they comfortable opening their markets? You know, we were benefiting from that over the last 2 years. Now, broadly, China needs to open their markets even more. And the trade war makes that harder because of this tit-for-tat mentality between the U.S. and China.
How concerned are you about the increase in non-performing loans, as you talk about, and the idea that China is providing net less liquidity to its companies and banks?
You know, that's a very good question. At the end of the day, it's very hard to say how bad is the NPL situation in China. Certainly, if it became disastrous and caused China's growth to slow much faster than predicted, that could be a problem for the global economy. We don't see that right now. You know, we see sort of managed growth in China for the foreseeable future, and really globally, global growth being anchored by the U.S.
Is there any region you're avoiding right now?
I don't think we avoid a whole region. Now, we will avoid going into asset classes or making investments where we're uncertain about the sovereignty. Our emerging markets teams often look at that, and they're comfortable in certain countries at certain times, and others, they back away if there's uncertainty.
We've heard a lot of companies, asset managers, say that they expect their private markets presences to grow dramatically. A number saying that they plan to even double their assets over the next 5 years or so. Where are you on that?
Well, in terms of private assets, of our $336 billion, we have around $90 billion in private debt assets and private equity assets. So I don't look at it as we're new to the game. We've been investing in real estate infrastructure, private placements, and for decades. So for us, it's really the continuing growth and expanding our resources into areas where we think there's opportunity, infrastructure debt, infrastructure equity, continue to grow our resources there as an example.
All right, so you don't have necessarily a target or an expectation as to how much the assets will grow?
We really look at it as we try to outpace the market by about 4 or 5% per year in terms of flows. And if we're generating net positive flow of 4 or 5% to the market, we're going to be in good shape as a firm.
So the big story of the past 5 to 10 years has been fee reductions across the board. And we've seen this in public markets and to some degree on the hedge fund side when it comes to the 2 and 20 model. Where do you see it going in private debt, private equity, and infrastructure?
Fees in a low rate, low return environment, fees will continue to shrink. And in fact, people talk about, well, why did direct lending come because of the bank's regulations? That's part of it. But part of it is the cost of originating that asset. We have clients who want that asset. We can go in there without armies of people building relationships with private equity and do deals. So it's that value chain between the issuer capital and the investor. You have to squeeze those fees because you're right, 2 and 20 doesn't work. Fees have to come down in every asset class.
That was my conversation with Tom Fink, Chairman and Chief Executive Officer of Barings. Now, you know he is treading carefully when it comes to more distressed China investments, but this is an area that's actually attracting a growing number of investors. And China is indeed starting to allow more companies to default and does seem more interested in protecting foreign investors. Yields are much higher than the potential recoveries are vast. Still, China is a big unknown when it comes to bankruptcies. Coming up, two brothers hit it big with fracking, but now the recent stress in energy has trickled down to their Permian holdings. This week's Billionaire Beat is next. This is Money Undercover on Bloomberg. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Time now for this week's Billionaire Beat, and we focus on the fracking brothers, Ferris and Dan Wilkes. The duo hit pay dirt during the shale boom when they sold their Texas company in 2011 for $3.5 billion. The brothers, though, have taken a hit of late as gluts of crude and gas depress prices. Bloomberg's Emma Vickers joins us now with details on the Wilkes. So let's just talk about who they are and how they got their billions.
Right, yeah. I mean, they're very unlikely billionaires. They started off as masons. They opened a small fracking company in 2002. And in the following decade, they built a company that they eventually sold for $3.5 billion, as you said, in 2011. So they were really the sort of original boom and bust story of the shale revolution. But things haven't been so good since.
Right. So the boom part was the $3.5 billion they sold it. Let's talk about the bust part. How much have they lost?
Well, it's a really good question. Yeah, I mean, they've made a lot of investments. They certainly haven't invested their entire fortune, but they disclosed a portfolio of investments worth $1 billion in June last year. This year, their most recent disclosure, that portfolio had dropped to $3.7 million. And of the holdings that they had originally, that they still hold, those have lost value by 88%. So it's a big drop.
So is this in tandem with some of the general lagging behind that we've seen in energy, or does this go beyond? Why are they tanking so much?
Right. Yeah. I mean, it's tied into the bust in the Permian Basin at the moment. The fact that oil prices have stayed very low for a long time means that investors aren't particularly sort of hungry to invest in that area, and a lot of companies have been forced into bankruptcy. 30 already this year, more than I think.
Can they make their billions back?
It's a really good question. And yeah, I mean, there are analysts that we've spoken to that say they're in a better position than most because rather than relying on equity, they have their own money. So they're on their own time frame to see a return on their investment.
It's so interesting, the idea that Masons all of a sudden become unlikely billionaires.
Right.
What are they doing other than investing in other shale companies with those billions?
Yeah, well, they've bought a lot of land. They've become the two biggest landowners in, the biggest landowners in Idaho and in Montana. And they're selling a lot of it off as private ranches. So they've done that. They've also invested a lot in Republican parties and campaigns. So obviously, you know, that's not a surprise necessarily.
Well, do we have a sense of whether there are a lot of billionaires like this out there that got rich really quickly in the shale boom?
It's a good question. It's not something that our reporting looked into, but given the way that the industry climbed and then tanked, I would have thought they can't be the only ones.
Yeah, which is fascinating and raises a lot of questions. We'll follow up on that. Thank you so much, Bloomberg's Emma Vickers. Now to early stage investing and a look at an Argentinian startup valued at nearly $1 billion. Tencent increased its bet on mobile payment startup Ualá, leading a $150 million Series C funding round. Joining us now from Buenos Aires with the details is Bloomberg's Carolina Milan. Carolina, can you tell us a little bit about Ualá and why it has gotten so much international attention?
Absolutely. I mean, they're making a big bet in a country where less than half of the population has a bank account. So by offering a free prepaid card, they're looking to bring banking services to people that have never had them. So far, since they've been open for a few years now, 1.3 million people have their card. And over the last month, they rolled out investing through their app. So this is what investors are betting on, that, some of these types of services are catching up, and folks are looking for new ways to access them.
It's interesting. Argentina doesn't necessarily seem like a likely bet right now, given the macroeconomics backdrop here. But how is venture capital more generally looking in the Latin American region?
So far, we've seen $2.6 billion in venture capital invested in the first half of the year. There's 3 times more than the amount in the previous year, according to an industry association. And the big part of that is the eruption of Asian venture capital firms, including SoftBank and Tencent, which have made big bets across the region and which sometimes have led to these startups tripling their valuations.
That's really interesting. So Tencent and SoftBank, how interested have they been in general in the region? I mean, can you give us a sense of where their focus has been, when it began, anything we know about it?
Yeah, so SoftBank this year launched a new fund focused specifically on Latin America. They're going to be piling $5 billion, which is a huge amount of money for the region. Of that, they've already invested $1 billion, and they've said that they have 300 targets that they're looking at. Of those, 200 targets are in Brazil. They've been looking at targets across the spectrum, not just fintech, but also fitness, delivery apps, and many others. And we've also seen Tencent taking smaller steps in the region and focusing on the fintech area of the spectrum, both with its investment in Walla, which was doubled down this week, and also in Nubank, another fintech based out of Brazil.
How is Uala doing, given the fact that the Argentinian economy has been struggling?
We've been asking that in our chats with the CEO. His answer is that the investors are looking at a longer-term bet in Argentina, and that the fact that so many Argentines lack banking services means that they will need to use these types of apps to access them. But of course, we've definitely seen investment in Argentine firms dwindle, and access to capital markets is locked out as spreads have gained so much because of the political volatility.
Bloomberg's Carolina Milan, thank you so much for being with us. It is time now for this week's big number. And it's a figure we just can't refuse. A $125 million mansion in Beverly Hills that was featured in the 1972 film The Godfather is in bankruptcy protection. The property, known as the Beverly House, was built in 1927 and sits on 3.7 acres of land. Previous owners include William Randolph Hearst, and it's where John F. Kennedy and Jackie O spent their honeymoon. That does it for us. Reminder, you can watch us each Tuesday at 1 p.m. New York time, 6 p.m. in London, 2 a.m. in Hong Kong. Have a wonderful Thanksgiving weekend. This is Bloomberg.